Adam. I'm taking a look here at a little screen I like to use. It shows me the last time we saw this big of an upswing. It looks like NASDAQ, we're up 2.5% roughly. Last time we saw that was September 7th.
Well, yeah, very different mood down here. I told you it was like a rodeo. Guys were hooting and hollering. One of the guys doing that, although you're generally a pretty level-headed guy, Ben Willis of Sunrise Securities. Talk to me about this rally. We're up now almost 150 points. You surprised?
No. I was talking to Laura Lee earlier this morning, and most of the traders I've been talking to were looking for what we call a ricochet rally, a reflex rally. We've been so oversold that it appears that the trigger for this ricochet was, in fact, the statement from the Financial Times. But that being said, every person I talked to, every professional trader was looking for this kind of move just because the volatility is so high and we were so oversold for so many days.
So too dangerous to be short.
Correct. Very correct.
Here's the real question. Is this real buying?
Well,
I mean, are you seeing some of the large orders from institutional guys?
Without disclosing too much, the orders I had from institutions today were on the buy side.
And were they real orders, not just 10,000 shares here and there, but 100,000, buy them over the day, et cetera?
I can't get to, but they're institutional orders, and they were buying. So that I was pleased to see.
All right, we went through a very critical level. We're back above it. We're now 1124 on the S&P. Does that give you comfort? Guys will come back in tomorrow and do some more buying?
Well, with the volatility where it is, we're still in a market based on fear, not on fundamentals, so a headline will change any direction we have. Like we're seeing that the rally that we thought we would have, whether it continues for another day, it should, but another scary headline will change that direction in a heartbeat.
Yeah, it's true. Well, all right, thank you very much, Ben Willis. All right, let me give you the final numbers here as I look up at the board. Dow's going to close up 156 points. Quite a difference from this morning, down 250. The S&P is up about 2.3%. Looks like the final print coming in 1123. Again, back above 1120. That's key. We stopped there 6 times. Finally, we're up, and we now have the comp up about 3%. That, again, a very large move. So I tell you what, let's bring in Nick Sargen from Fort Washington Advisors. Nick, you manage about $38 billion. I got to think your P&L is looking a lot better today at this moment than it did early this morning at about 9:30.
Well, that's to say the least. I think, the big concern obviously was that you were on the cusp of bear territory, down 20% or so. And I was just imagining, the headlines tomorrow, and it kind of feeds on itself. And what this market is so desperately in need of is reassurance that the Europeans can get their act together. So, all we know right now is a headline, but all I can say is long, long overdue that they should try to address these market concerns.
And how much of what's been hitting the market so hard is Europe as opposed to just slowing GDP growth here in the city? If there were a seesaw and you had to put the fulcrum somewhere in the middle, where would it be, Europe versus U.S.?
I think of late, I would say that the news has been overwhelmingly Europe. And I mean, the example was yesterday, you actually printed a decent ISM number for the U.S. Admittedly, the global indices aren't quite as good. So, I mean, those are in the backdrop. But I still think, if you said to me, I didn't have to worry about Europe, I would be feeling okay because I'd say we'll muddle along. But if I have to worry about financial contagion, then I'm talking mega risk, and that's the thing that nobody knows how to assess.
Now, how do you feel about valuation here, roughly 11.5 times next year's earnings?
Yeah, I think the valuations are looking very attractive, and we have a variety of metrics that we look at that are basically saying to us this market is looking attractive on a longer-term basis. The but is when you're facing a crisis of confidence, and that's what's going on in the United States and what's going on in Europe, do you jump in just because it looks cheap, or do you have to have something telling you that policymakers are, doing the right thing? And that's what is holding everybody back from taking advantage of these cheap valuations.
Now, Nick, you got $38 billion under management. That's a big number at Fort Washington Advisors. So what are you doing with the money?
It's interesting. I would say for the most part, we've been on the sidelines on equities. However, if there's one area that we've been willing to add exposure to, it's been in higher quality dividend paying stocks. I think it's a good defensive play, and it makes sense in a very low interest rate environment. And, the market likes those. So that's been kind of the safe area. But I would say right now, rather than necessarily jump into the stock market, I think on a risk-reward basis, we're actually finding some good value in high-yield bonds, especially higher quality, those in B-rated space rather than C-rated space. And that was a good strategy for us when we began to dip our toes back into the market in 2009, and we're looking at that right now.
Nick, I want to bring in someone else at the moment. We've got Bob Iaccino, founder and president of A Trader Outlook. He trades across every asset class, and he's coming to us live from the CME Group in Chicago. Bob, great to have you here on Street Smart. Let me connect the dots, or ask you to connect the dots for us, actually. We heard Nick there talking a little bit about high-yield debt starting to look attractive. What looks attractive to you right now? And when we take a look at the action we saw into the closing bell, how do you interpret that? I mean, stocks turned around pretty quickly. Not a big movement, though, really, in treasuries. We're still seeing the 10-year yield fairly low at the moment, around 1.83%. But what about the other asset classes? Is there something now that you'd go in and buy?
Well, let me take a step back, if I could, and sort of connect some of what Nick and the previous guest from the NYSE was saying. You're looking at a classic short covering rally right now. These big down days do not get covered by massive institutional buyers like Nick at Fort Washington Advisors. They don't dip their toe in the water on a low off of a headline from the EU. We've had several headlines from the EU. This one is one of the less memorable ones that I can think of, but still trading is so short in duration and so quick to the trigger that positions get covered, and that's what's happening here. Now, Nick also touched on the way that they reacted as a large institution in 2009 when they started dipping their toe in the water. This is 2008, not from a perspective of the massive economic failures we may see, but from a perspective of the way that things are trading. Dollar index goes above and gets stronger, above 77. Even gold fails a little bit. When the dollar starts to weaken, more liquidity, stocks will be supported, institutions will buy the high-yield corporates, and the rally can come from there. I look at this as being similar to 2008 as a good thing, as if we can buy banking stocks like J.P. Morgan and dip our toe into the water into that type of a situation, buy gold to possibly hedge that, buy a few commodities, and get back some of these losses people have seen.
Bob, for the average investor, you buy it and never look again, or just don't open the statement until a year from now, because it's easy to get caught up in sort of the daily gyrations and feel like you're better off on the sidelines.
Well, look, the average investor isn't in the market right now, and that's part of the problem that we have. What I feel that people need to do is they need to learn what trading is. They need to learn what a closing rally like this actually is. It's not people like Nick from Fort Washington coming in and putting $8 billion to work. Okay, they do things a little bit differently. And they need to understand that these types of gyrations, it is noise. But there are crises. If your duration is 2 years, I'd worry a little. If your duration is 10, I wouldn't worry so much. Short term, there's a rally coming in the S&P. There's divergence in the technicals. We had a lower low, but yet weaker bearish momentum on some of my indicators. So there is a rally coming. I talked to your producer about it. I think the rally starts today, but then you have to be careful again. The market tends to rally in 3 to 5 day spurts and then collapse in 2 day spurts. That scares investors.
Hey, you know, Nick, it occurs to me as I listen to both you and Bob talking about volatility in stocks and almost more inclined to go into bonds. You mentioned you're looking at some of the high-grade bonds. What kind of yields are you finding on these bonds? And are these bonds that people can buy at home, guys who are watching?
Yes, you know, I would say, you know, give you an illustration of the worst part of the 08-09 period. You were getting junk bond yields, and I'm talking, you know, not lowest quality. You were getting high teens, 20% or so. You're not there today, but you had gotten down to yields 7% or so. You're probably now talking, you know, 8-9% in that area, depending on the quality. And again, I'm emphasizing we're focusing on more in the B spaces, double B or single B, not in the lower rated C space, which is more equity-like.
Nick, by the way, good to see you again. I don't know if you recall, we worked together a long time ago at J.P. Morgan Private Bank, many moons ago. Good to see you again in a different context.
Good to see you.
Let me ask you about emerging markets. We were just talking to Bill Gross about emerging markets, and many analysts and investors have said this, that some emerging markets actually look attractive right now because their economies are insulated from what's happening. Now, that sort of, I think, defies sort of traditional thought, which suggests that many of those economies are actually export-driven. Are you starting to take a closer look at that sector?
I would say right now we haven't done a lot of investing on emerging market equities. We've done it in some other asset classes, private equity and the like. But I would say, in general, to your question, I think that, emerging markets, the fundamentals are better than in the developed markets. So why are they selling off more? The technical jargon is they're higher beta plays. In other words, when we had that rally from March of 2009 to April of this year, the emerging markets as an asset class went up 160%. U.S. equities went up 100. So there's just a normal, they rise more on the upswing, they sell off more on the downswing. Given now that you're talking about some emerging markets off 35% or so, I think there is some appealing markets. I think the biggest uncertainty I have right now is, some people are nervous about China. I'm watching it closely. I don't yet see convincing evidence of a major slowdown there. Some say because of the commodity prices, it's a matter of time. That's a key market for me to be following to gauge kind of the general trend, because I think as China goes, so go a lot of other EMs.
All right. Thanks so much to you both. We got to leave it there. Nick, good to see you again. That was Nick Sargen, Chief Investment Officer for Washington Investment Advisors. We also had Bob Iaccino, founder and president of Trader Outlook, joining us, of course, from the CME Group in Chicago.